So as a real estate investor, you want to look at your whole picture. You want to make sure you're on the same page with what you're doing from a tax planning standpoint with your accountant or CPA and what your lender and your financing needs to be. Welcome back, everyone, to REI Tax University, where we talk all things tax planning for real estate investors. And again, as always, we are so appreciative to have you guys here. We have a community over at reitaxu.com. So if this is content that you guys find valuable, please go over there. But we love to have you here on the YouTube channel and super excited that you're following along with us here on our series on depreciation. In our video here today, we're going to talk about some of the ancillary things and next step strategies that come up surrounding depreciation. So financial considerations you might want to be aware of with your lender and your financing, especially when you take on some of this bonus depreciation. We're going to talk about the 1031 lazy or the 1031 light. That's another kind of next level strategy that is not always best for everyone, but it can be effective when used right or when something like a normal 1031 exchange doesn't work for an investor. We're going to talk about things like de minimis and when it could make sense to set something up as a fixed asset versus expensing it and vice versa. And I want to take a few minutes just to talk about some timing considerations and things to keep in mind in years that you might be meeting real estate professional status or your short-term rental and meeting material participation on that, or maybe your spouse is meeting it. But those are all things you need to consider as you determine if it's worth taking bonus depreciation or if it's worth implementing a cost segregation. So we're going to touch on it a little bit more in this video here today. So let's start here with talking about the sunsetting TCJA, the Tax Cut and Jobs Act. So this is not a political channel and we are not going to get into politics here at all, but this is the act that was implemented in late 2017 when Trump first came in and made a bunch of tax changes at the time. It had some advantages to a lot of taxpayers and to others it hit the opposite way. So a lot of the items that were implemented were temporary and a few of them were permanent. And the way this all comes into play right now is that bonus depreciation was one of those temporary items. So the way that worked was prior to this act, bonus depreciation was 50%. The act then said, let's bump it up to 100%. And from 2018 to 2022, it'll be 100%. And then it's gonna start to go down 20% a year. So if you buy something big, fixed asset, a building, whatever, if you buy it in 23, bonus depreciation in that year is 80%. If you buy it in 24, it's 60%. 25, it's 40%, then 20%. And eventually by 2027, bonus depreciation would be gone. Now, will it go away completely? Nobody knows, right? Will it come back to 100%? Nobody knows. We hope it does, especially from a real estate investor standpoint, and especially from those short-term rentals that we're taking a lot of advantage on and using that short-term rental loophole that some of you are doing. You know, we're shooting this video in late 2024, so all these items are as of today. We can't use a crystal ball to predict into the future. Again, what I can tell you if you watched our earlier video is that bonus depreciation has been around in some form since 2002, when it was first enacted at 30%, and then it stayed at 50% for a long time. It incentivizes the economy when businesses buy stuff, when real estate investors buy stuff. It's generally good for the overall economy. Also, there are a lot of people up north that are real estate investors and that are business owners. Those people, those lobbyists, those politicians, like they generally like bonus depreciation. So will it stay? Will it come back to 100%? We don't know. But again, that's all stuff that you can consider as you determine what you think could happen. So I'm going to touch on this subject lightly here today. And again, we'll probably get deeper into this in a future video, but this is something that's often called the lazy man's 1031 or the 1031 lazy or the 1031 light. Again, I don't find a ton of people that are very in-depth knowledgeable on this strategy. I find even fewer that have used it, but we have used it for a few of our taxpayers. It does work very well when it works. So we want to make sure you're aware of it. And again, just to touch, a 1031 exchange is when you take one property, you sell it, and you defer your capital gains by investing in another property or another like kind asset, right? That's a 1031 exchange. And you don't have to pay the capital gains tax right now, or maybe you only pay a portion of it. A 1031 light or lazy man 1031, it's actually not a 1031 exchange at all. What happens is 1031 exchanges are incredible tools, right? And they're amazing for real estate investors, but they can be really hard to meet. They have some strict requirements, some strict timing requirements. You have to meet debt requirements, there's ownership requirements. Like it's always one of our top, like our A, like do this if you can do it. But sometimes people can't, it just doesn't work. So then we want to think about option B or C, which may be a 1031 light. And that's really not a 1031 exchange at all. What a 1031 light is you just sell your property outright. The property that you were going to sell or considered exchanging, you sell it. You're now potentially sitting on capital gains. So let's say you're sitting on capital gains of $75,000. In the same year that you sold that property, you go ahead and go buy your next property. You want to buy that property at a point where it will create enough bonus depreciation, and you can use a cost segregation study on it to create bonus depreciation and create a large loss over here. You're going to then match the two up. So the large loss you created over here on the new property can offset your capital gains from the one you sold. This is a real complex topic. It's very situational. You would need to talk with a real estate accountant about this, or do your own research and knowledge on it, watch our future videos on it, and go educate your accountant on it. Make sure they know what's going on. Make sure you use the cost segregation study correctly. You use a good engineering firm on it. You're also probably going to either make sure you have passive income, or you meet real estate professional status in this year, or it's a short term and you materially participate. You're gonna wanna, there's a lot of things that could go wrong here. So you wanna get this right if you're doing it. It's not something you should go about on your own. The next piece I want to talk about here is the lending and the financing implications, and to make sure you're keeping all that in mind when you think about your tax planning. So tax planning is what we do, and I find that people often think about their tax planning and reducing their taxes in a bubble. They get so focused on, I'm going to do this strategy to reduce my taxes and this to reduce my taxes, that they lose focus on other things that matter for their business. So things like cash flow. Cash flow is king. So like, I would love if you go buy that truck by year end and we get depreciation on it legally and we do things right. That's great for me from a tax planning standpoint. But if that kills your cash flow and you now have a large loan that you took out on that next year to pay back, that likely wasn't the best move from an overall business standpoint. So as a successful real estate investor building a portfolio, you want to make sure you're on the same page with your lender and with your financing, along with your CPA and your accountant from a tax planning standpoint. You want to make sure that if you're doing things over here to get your taxes down and do effective tax planning, that that's not going to affect anything that you're able to do from a financing standpoint. And there's a ton of options and products out there like the DSCR loans and things that use your rent rolls and things like that that don't take as strong of a look at your tax return stuff that might be able to work. But overall, in general, a lender and an underwriter is not going to want to look at your tax returns and see that you had large losses every year, or that you've had large losses for a while. That's not going to look good to them. So they're going to start to look at that a little bit stronger and see, do you still qualify? So depending on what you're doing, if you're doing more conventional financing, those are things to keep in mind. Now, the good news here is that depreciation expense, and especially bonus depreciation, that is one piece that most lenders will typically add back to your bottom line. So when we went through our examples, if you had 50, 60,000 of a loss and 80 grand of that came from depreciation, oftentimes they will go ahead and add that back to your bottom line, so that instead of showing a $60,000 loss, it looks like a $20,000 income to them. But again, you want to touch base with the lender and make sure that this is something that's going to happen, especially if it's going to cause any issues for you. You also want to keep in mind your other deductions, because while they might add back depreciation, and maybe there's a few other things like one-time repairs that they'll add back at times, or maybe they don't need to consider your tax return, which is good. But if they do, they're probably not going to add back a lot of these other expenses that you're going to max out. Things like your auto deductions, your telephone expense, some bigger repairs and things like that. So you want to keep that in mind, because that might make the difference on whether you decide to expense a repair versus setting up a fixed asset and taking depreciation on it. Or it might make a difference on how much of a travel deduction you want to take this year, or how much you want to spend on travel this year. Because yeah, you can offset taxes, but if that's going to have a negative consequence on your financing overall, those are things you want to keep in mind. So really what you should be doing as an investor is just knowing, hey, this is what I'm doing. I've got a tax projection ran. This is what my tax return should look like, and know that in the fall of the year. Then if you have any lending implications with your lender, go to your lender and show them that and say, hey, this is what I'm going to look like. I need to re-up. I need to get this property. I need to do this next year. What's going to work? What's going to happen? Do that now. Do that before you file the tax return. And then you take that return to them and they won't go off of that return. And then either you have to amend a return to change something there, which causes red flags and all kinds of issues, or you have to go find a different, less advantageous way to finance the deal. Now, I want to quickly touch on something called de minimis in the safe harbor. And what this is it says that anything that you purchase that is over a 1-year useful life, which should typically be set up as a fixed asset, you may be able to go ahead and just expense it right away. And they've set that amount at $2,500 as of this date in 2024. So if you go buy new windows for a place and they add up to $2,000, You can expense those if you want. You could set them up as fixed assets and depreciate them. 9 times out of 10, the investor, the business owner, they want to expense those. They want to get the tax deduction this year. They don't want to have to mess with potentially paying the capital gains tax when they sell those, worrying about depreciation recapture. So they end up expensing those de minimis type items. However, going back to those lender requirements and things like that, there may be stuff that you're like, I want to show a better income this year, or I want to show a bigger depreciation expense versus a bigger repairs or supplies expense. So those might be reasons that you decide you're going to go ahead and set up those fixed assets and depreciate them straight line or take bonus on them. Other items to keep in mind here are timing considerations. So again, all these losses are great. We like to get our income down from a taxable standpoint. We like to create these tax losses. We like to accelerate them and get these large tax losses, but we need to do so and make sure that we can use them. So if you have passive income, we definitely can use them, right? We have passive losses that can always offset passive income. That's great. But if all we're doing, if you don't have anything else they can offset, if you don't meet real estate professional status, your spouse doesn't meet it, if you don't have passive income, if it's not a short-term rental that you're materially participating in, and you're over 150K in taxable income, then you may have just created this loss that you can't use right now. It just gets carried forward. It's a passive loss. It gets suspended on the form 8582 of your tax return and just carries forward until a future year when you have passive income or you sell the property. So, we don't want to jump through hoops to create losses if we're not going to be able to use them. So again, the two main ways to use those is if you meet real estate professional status, and that's out of the scope of this video, but in general, you need to work at least 750 hours in real estate, and it's got to be what you do with over half your serviceable time. So any full-time W-2 people, that's usually out. The other way to do it is if you have a short-term rental, you just need to materially participate. Those are a little bit easier. There's several rules you can meet to do that, but two most common are you work 100 hours and more than anyone else in the property, or you work at least 500 hours in the property. And there's some different rules of that. On the short terms, you can combine spouses' hours. On real estate professional, maybe one spouse meets it and that means they both meet it. So again, we've got other videos on that. Definitely jump into some reps videos, real estate professional videos, or our short-term rental videos that we get up, and if you want to learn more on those topics. But all that's to say, those are year-by-year classifications. So if you're going to meet those one year, that might be a great year to take big bonus depreciation, to buy things to accelerate that, to use a cost segregation study. That might be a good year to do it. If you're not going to meet it the next year, then that's probably not a year you want to do it. We can't use those losses. So just keep in mind, if we're creating the losses, what year can you use them? And maybe next year is going to be different than this year. Maybe you're quitting your W-2 and you're going to be a real estate professional next year. So again, keep all that in mind because timing is important when we talk about this stuff. As always, we truly appreciate you guys following along with us, and we hope you're gaining a lot of good value out of the content that we're putting up here. But if you like these videos, it's giving you some good valuable information, please like and subscribe. Jump over to reitaxu.com and join our community over there where we talk about all things tax planning for real estate investors. And we really give out some templates, do some postings, a lot more than we can do here just on our YouTube channel. But again, we love having you here. Keep watching along and following, and hopefully you've got a lot of value here and you understand a lot more about depreciation.